You're listening to ASOTU CON sessions by Space Auto, recorded live at ASOTU CON 2025.
We're live on the ASOTU CON podcast stage, powered by Space Auto, and in the heart of the action here at ASOTU CON 2025. I'm Steve Greenfield, and I'm here today with Bill Cariss, Chase Fraser, and Brian Donnelly, talking about investing in the future of auto retail. There you go, guys.
Nicely done.
No pressure. All right. So why don't you guys introduce yourselves? Maybe let's go around. Brian, if you want to start. Who you are, what your firm is. Give us a little context about Autotech Ventures.
Yep. So Brian Donnelly, Autotech Ventures. We got started back in 2016. So we are actively deploying our third fund as we speak. All things.
How big?
A little over 500 million under management across those three funds.
That's real money.
And so all things ground transportation and mobility, retail technology is certainly a big part of that, but also everything from off-highway autonomy, marketplaces. We do some deep tech work as well too. Teams based out in Menlo Park.
Stage, size of check?
So we are, I would say, early stage, seed, Series A is typically where we play. You know, we try to make about 15 to 20 investments per fund, which drives the check size, anywhere from 2 to 5 million, I would say, is probably initial check. We've written some smaller checks. We've written a few selectively bigger than that, but it's a little bit more about the portfolio construction, a little less about how much we're putting in initially.
And then just a high-level thesis, because we will dig into the thesis for everybody, but high-level thesis, as you explain, what's the elevator pitch on your thesis, other than ground transport?
Specifically for retail?
Well, you guide me.
Yeah, I would say, retail specifically, there's probably 4, maybe 4.5 buckets that we're taking a look at now. We've invested in some, we're searching for others in those spaces. So one, I think a big conversation here at this conference is also profitability of these retail stores, which I would say the half step to that is the operational efficiency side. And so how do dealers become more efficient buying and selling vehicles? How do they become more efficient in their operations? How do they become more efficient with the talent resources that they have? Number 2, I would say the transition to EVs have been messy. We think they'll continue to be messy, and we think that provides a lot of opportunity. So residual values, the financing of these things, the aftermarket, the buying and selling, getting them into the hands of the right consumers. Consumer affordability or customer affordability, I think, is probably a big one as well too. And so we've made some investments on some fintech type investments that are specifically focused on trying to make things a little bit easier for the consumers. And then last but not least, it's really the talent scarcity and the ability to retain people. I caught the tail end of your conversation today, and I think I agree with this transition to artificial intelligence, where today we're co-pilot, tomorrow we're agent. In some place we're probably getting into the replacement. The time horizon to that is probably the unknown, right? And we think that there's a lot of opportunity in the short and medium term to retain great talent.
Very cool. Well, thanks for being here today.
Of course, thanks for having me.
Chase, same question. Who are you? Tell us a little bit about FM Cap. Maybe give us a little bit of the history too.
Chase Fraser. I was the founding partner of a firm called FM Capital, and so the history on it. Red McCombs, there's a lot of dealers here in this event. Red was my original partner, and Red had done a lot of investing in the space, and so understood it. I sought him out. He was very much a mentor for me. At this point, I'm in my 40s, and Red's like 85, so it's like great being around a guy like that. So we kicked it off. FM Capital is Fraser McCombs Capital. We don't say that anymore, so it's FM Capital. And we've been doing this for a long time. We're fourth fund, just closed $240 million, which we were super excited
Congrats,
about.
That's great.
Yeah.
Congratulations.
Yeah, and thesis-wise, I'd say about half of the portfolio is in this room. It's dealer tech, broadly stuff that's helping manufacturers and dealers service and sell more vehicles. And the other 50%, broadly speaking, is mobility. Hearing you talk, ACEs, right? It feels like that's a little bit of an overused and kind of getting tired theme, right?
So when you say that, just for the audience's benefit, what is that?
Yeah, autonomy, connected, electric. So those are areas that have not bluntly been great from an investment standpoint, at least thus far, right? And so we're a bit more opportunistic right now in mobility. We actually had a meeting about this yesterday. I know, Steve, you're in the space, and we're seeing a lot of niche players now, which is nice. I like niche, right? You and I are invested in a couple of little niche players. So we're being more just generally opportunistic outside of dealer tech.
Great. And at $240 million fund, average check size, what stage are you looking at?
Yeah, we've had to go upstream a bit, where it's now $5 to $15 million checks. I'm in some deals with you, as you know, and we were doing some $1 and $2 million checks, and it's just tough.
Yeah.
Because you end up having 50, 60 investments, and that's really, really hard to manage. So, but there's still a lot of opportunity in that kind of $5 to $15 million check size.
That's great. Awesome. Bill, how are you? Bill always has the best shoes. Always.
Those are good shoes.
And they're always very clean. I wonder
Right
if
out of
he
the
cleans
box.
them before or he just brings them in a box. But either way, I want to ask.
My secret.
Your secrets. So, Bill, you're a little different. You've been an operator. You migrated to corporate. And then now you are running a VC firm. And there's maybe, I don't know how much you can share about this collaboration too, but we'd love to hear about that. So talk about the lineage. Maybe give us the background of Holman overall. Sure. Why did they start a VC firm? And then get into your investment thesis, et cetera.
Yeah, thanks, Steve. Thanks for having me. And by the way, thanks for everything you do for the industry. You're great. Just love having you. How about a hand for Steve? I always say there's 4 Steve Greenfields running around because I don't have the energy.
There may be my secret as well.
So Holman, 101-year-old firm, started off as a single point Ford dealership in New Jersey and have grown to 59 rooftops, 77 franchises, and that's actually our second largest business. Our largest business is our fleet management business. Brag numbers, we have over 2 million vehicles under lease or management, do a lot of really large corporate fleets like Comcast and FedEx and all them, but our bread and butter really is like the 300 to 500 vehicle fleet because they need us more. FedEx needs us for a certain sliver of fleet management. They don't need us for everything because they've got dozens of people that help run their fleet. That 300 to 500 vehicle fleet, they rely on us, very consultative sales. So we love that business. Our third business is a manufacturing and upfitting. We have 11 truck plants that some do actual manufacturing. We're proud to say we manufacture in the United States. There's some things going around politically right now in and around doing that. We don't source all of our parts from the U.S., but we manufacture here. We do a lot of upfitting. So that's the source of our business. It was about 10 years ago that the family and the senior management team said, what are we going to do if we get disrupted? What happens to the state franchise laws? What happens to the dealership model? Will dealerships be here? If they're here, will they look different? And so we spent a lot of time researching, strategizing, brought in the PwCs, Deloitte's, McKinsey's, all of them, and said, what do you guys all think? Talked to a bunch of people, and then we just set out on a strategy that, now it's commonplace, but back then it was kind of innovative, like let's disrupt ourselves. If somebody's going to do it, let's do it ourselves. So that really began what was Holman Strategic Ventures, and we were actually building some platforms. We built 3 platforms, one of which we sold off to Lyft, a really cool deal. I know you know about that with FlexDrive. Mm-hmm. It powers Lyft's fleet right now, which is super cool. And oh, by the way, Holman is the fleet management company for Lyft. So it's
how convenient.
Kind of nice, yeah. When you have a B2B, B2C play, that's where it's a really nice play. So where we've come from all that, Steve, is where we are right now is we have a investment team of 8 of us that do investments. We have 20 direct investments. We've exited 4 of those, so 16 active portfolio companies. We'll do checks that are as little as $250,000 up to $5 million. We don't have to use the companies we invest in. Right now, about a third of our portfolio companies we have active commercial agreements with. We'd like to do business with them all. It's just a matter of, can we make that happen, and can they handle us, and can we make sure that we can add value? So that is what we do on that side. As you know, and you're alluding to, we just did something, I think, kind of creative. I wouldn't call it innovative, but creative, where we partnered with FM Cap. We were an LP in Fund 2 and Fund 3. We increased that LP stake dramatically, but then we also bought GP stakes, a minority part of that. So Holman, through me, is a partner with Chase and Mark right now, and we're really building out what does that look like, and quite honestly, in conjunction with, you all. I say all the time, one of the things I love about venture is it's a team sport. There's not sharp elbows. We love investing. We were just talking about a couple of deals that we're invested in, and like, hey, what are we doing? How are we going? Whether we're on the board or not. That's the fun part about this, is like, how can we create value for the people that are here in this room, us and our LPs all throughout. Last thing I would say is we do dealer tech, but because of our business, we go significantly beyond that. We've made 3 investments in the robotic space, autonomous mobile robots, software. We're not really a hardware player as much as software in that space. So think like the ERPs that will connect a robot that's bringing something, in the WMS, warehouse management space. How does that get into your DMS or ERP of that business? So all kinds of really cool things there. And then the other piece we do a lot in and around is we have 500,000 connected cars through our fleet space. Right. We build a lot of software, and we love investments in and around that too. So all automotive related, but we kind of go tangentially from there.
Cool. Well, hold on. Before we go there, I'm going to be the acronym police here, because some folks may not know all the terms. So you use 2 terms, LP and GP. Maybe before we go there, just want to define what those are for the audience?
Yeah, sure. So LPs, let's start with the GP. So these guys are GPs, general partners. General partners means they own the fund. Okay. They manage the fund, but it's their fund. They're the equity holders. They then go out and raise. I think the funds are pretty similar in size. Let's say both funds latest are over $200 million with these guys. So that $200 million comes from LPs. And those LPs can be, $500,000 up to, $20-25 million per, and they become an LP. So we've been an LP in FM. We've been an LP in really interesting incubator in Silicon Valley called Plug and Play.
Mm-hmm, yeah, sure.
So we're a small LP in one of their supply chain funds. That's helped us a lot, quite honestly, on the robotic space, the WMS, warehouse management system space. So we're an LP there. The unique thing was that we bought into GP stakes or partnership with Chase and Mark.
Which is the first time you've done that?
First time we've done that.
Cool. Chase.
Yeah, and what's very unusual about the 4 of us sitting up here is we're not competitive. We're friends. We're in this industry. This industry's pretty small. We do deals together. Just for the folks in the audience, that doesn't happen in other verticals, other general VC. It's very, very cutthroat. It's very, very competitive. We like each other. And so that helps us in the industry in a big way because we share deals.
Cool.
And I'll just add to that too. I think we all have a vested interest in making these great entrepreneurs out here successful, right? Whether it's through investments from FMC, through Autotech. We want these guys to succeed. We want you to succeed because ultimately I think that is the driving force to the innovation that's in this marketplace. And so I think as we look at all of these opportunities that are out there, there's far too many deals for us to invest in, specifically you as well, right? And so I do believe that, operating from a place of strength amongst, the various funds that are represented up here are really good for the ecosystem and all those great entrepreneurs and builders that are out there, because it also gives them confidence, right, that there is somebody that can help support those dreams and hopefully partner with great companies, get the capital they need to drive. And so it is a very different and unique. I come from the world of banking in New York, and even if I texted somebody a competitor's name, we would get fined by the FTC, right? And so it is a very, very different and unique industry and one that I love.
Good.
So many of these startups need connections. Like they need the cash, but what they really need more than cash is, hey, introduce me to that dealer group. Introduce me to Cox. Introduce me to whomever. And if we can't get there, somebody else on the stage can get there. So the working together is really, really important.
So when an entrepreneur is looking to raise money, I'm going to use a little bit of segmentation, so you guys help me. There are corporate VCs. Bill, I put you into that bucket. And there are financial VCs. You guys are, Chase and Brian are in that bucket. Help me understand, anybody who wants to take this, the difference between how a CVC operates and thinks versus a pure financial VC, and why one or the other might be attractive to an early stage entrepreneur looking to raise money.
So I'll take the CVC. I know that one pretty well. And by the way, there's multiple CVCs here. I know, we're really close with the folks from CarMax, which people are like, wait a minute, aren't they a competitor to you? And I think it just plays into what Chase just said. Of course, they've, two of our largest stores in New Jersey, there's a CarMax, like literally a driver and a 9-iron away. So we are, we compete there, but we share with Terrence and Nuge all the time. What are you investing in? Can we club up, which I'll leave that to you guys to talk a little bit about that, which means let's us invest, you invest, let's have Assurant Ventures or somebody else invest as well, and let's put this company on the map.
Right.
Sorry, we kind of say that. We say, let's help put this company on the map, which I know a lot of startups love that. And a lot of times we'll say, now it's just up to the entrepreneur. If they can execute, we're going to send a lot of business their way, and let's back them. We do that multiple times. There's others around here that are CVCs. We have anywhere monthly or quarterly calls with at least 10 other CVCs. What are you looking at? What are you doing? Why? Can I look at your diligence? Obviously NDAs, we make sure we honor NDAs. But what can we do? Why are you using them? I've had multiple conversations on 2 companies that we're invested in. How are you using? Why are you using? What are you doing with that? That is tremendously helpful for us. Like I said, we don't have as a mandate we have to use the company to invest in them, but if we aren't open to using them at some point, we won't invest, if that makes sense. Right. So I always say, if somebody says, are you doing business with them? I say, not yet.
Right.
It's not no, it's either yes or not yet.
So there are different flavors of CVCs, though. So help us understand, since you're so well networked, some of them are very dogmatic that there has to be a commercial relationship. Some say not at all. So help us, because it's important for the founder who's taking money from a CVC to understand this dynamic.
Yeah, great question. And this is something I learned 9 years ago. My friend and partner to my right explained this to me, as did a few others, and said, hey, listen, you're going to get in this space. There's a couple words you don't use. You don't use exclusive. I'm like, whoa, we're Holman, really? I'm like, no, you don't use exclusive. And there was one that came up in your morning session, and you don't use ROFR. Like, no. And somebody said this morning.
And ROFR is what?
Danny said, right of first refusal, which means I get, and the way it works, if I have a ROFR on one of the deals I've invested in, it means somebody else offers you $50 million for the company, I can match it. It chills the price. And everybody else is like, are you kidding me? You gave a ROFR. Yeah, so I think Danny said it this morning, somebody asks you for a ROFR, run. Great advice.
Good advice.
Me, I mean, I've negotiated 1 million buy-sells. I've bought and sold dealerships. I know how to do that. I've asked for ROFRs. I've asked for, this is a different world. So there's things like that. And I forget who it was. I don't know if it was Chase or somebody said, dude, like, don't be that CVC. Like, don't be the one that, like, oh my goodness, like, oh geez, Holman's on the board. Like, this is the way you play well in the sandbox together. So CVCs done well can be a tremendous asset as an investor. Done not well will be your worst investor.
I'm going to come back to this. I want to hear about VCs now, financial VCs. I want to come back to, my next question will be about what does it mean to be entrepreneur friendly? So think about that.
Yeah, I think a simple way to think about the differences is we look at a lot of deals with Holman. And so we are aligned 90% of the time, meaning we're looking at the deal for the same reason. And in a lot of cases, it is financial return. But that 10% of the time, Bill will say to me, I'll say, like, why do you like that? And he's like, well, it really helps us over here in this part of my business. And I'm like, oh, okay. I get that. I wasn't going to do the deal from a financial standpoint because I didn't think it had the upside. He may do a deal, putting words in your mouth, that maybe has lower financial upside, but it dramatically helps some aspect of his business.
Makes sense. Now, over to financial VCs. How do you think they're different? Because you have a lot of LPs. He has one LP, right? Limited partners, the investors. How else are they different, and how do they think different?
I mean, Bill helped me with this, but I don't think there's like a lot of difference other than the strategic investment where you're like, okay, I want that thing for that reason. I feel like you and I are aligned on virtually everything else. Would you?
Yeah, we are 100% aligned now. When we first started, financial returns were not our number one goal. Our number one goal was learnings and optics, disruption. What's disrupting us?
How would you measure that? Like at the end of a year or an investment, how would you look back and measure the effectiveness of those things?
Yeah, I mean, obviously subjective. So here's why we invested in this company. I mean, we do IC memos. We do 15-page IC memos like everybody else on stage.
IC is what?
Investment committee.
Okay, good.
You're killing us with the
That's all
acronym.
right. I'll call them out. I'm here for that purpose.
Come on,
I know.
I'm serving some purpose.
So we do those, and in there we will say, here's why we're investing. We have flipped our motivation for investing from learnings and optics to, and then returns were like number 2 or 3. Right now returns are 1, 2, and 3, because if you are not getting returns, the best founders won't come to you. Everybody wants to partner with a winner. And now we could get away with it because, we're giving you ARR, all that. Right now, we want financial returns, but to Chase's point, I will take a little less on a deal. Like, I don't know, we try to underwrite to at least a 3 or 4x, knowing some will be a 0. So we want to be at least a 3 or 4. I'll underwrite to a 2 or 2.5x, which you don't do in venture knowingly, if there is something strategic. So right now, we invested in a company multiple times, a company called Formant, that's in the AMR space. We, bad secret, but we may or may not launch a robotics business sometime in the next year. We've been looking at it for 2 years.
Nice.
The way we look at it is we do fleet management of cars and trucks, AMRs, fleets. We can lease, we can do fleet management, we can do connected robot versus connected car. Formant has become more than just an investment. They are part of our tech moat in that space. So very, very different the way we structured that. Chase looked at the deal and passed on it, actually sent me the deal 4 years ago. We have put 3 different levels. We have a lot of money in Formant right now. Very, very strategic. So I would say that is the difference right there. We're perfectly aligned now because it has to make IRR sense for us to do it, or we won't be here as a CVC.
IRR is what?
Thank you. It's essentially, for those of you, most people think of ROI. ROI is I invest today, I exit in 3 years. What's the return? IRR is the same thing, but a stream of cash outflows, cash inflows, so internal rate of return. Internal rate of return, you've got to be, in this space, mid-teens is kind of you better be there, net of fees. You better be mid-teens, or those LPs next time around are going to be asking a lot of questions.
And I want to hear from Brian on this one, but 30 more seconds on a difference I just thought of while you were talking. Our LPs really, they're financial first. You sit down with them, you pitch them, and they're like, okay, you got to make me money. So that's the initial driver. But as they get into it with us, a vast majority of our LPs are strategic. Strategic meaning they're in the automotive industry. What it ends up becoming is it's 50% make me money, 50% provide me value. Show me things in this industry that I don't know about, and or teach me things in this industry that I don't know about. And so I didn't know that was the business I was getting into. I thought I was fancy pants, VC, Silicon Valley guy. It's not at all what my business is. We spend a lot of time with the LPs helping them understand what's coming around the corner.
Brian, the mic is all yours.
Yeah.
For as long as you want.
It's a really important question, and I would really press the entrepreneurs listening to this to ask this question about those that are going to potentially be on your cap table between financial VCs and CVCs and what their motivations are. And so our perspective, we are 100% financially motivated. We will not make a single investment unless we can see a world in which that one investment has the ability to return the entire fund.
So how many times would that be? Is that 100x?
Well, if we do some quick math, right? So Fund 3 is about a $235 million fund. We're going to make 15 or 20 investments out of that fund. Let's say, and we can get into reserves versus initial, checks as well too. But let's say we've got half of that for initial investments. We want to be able to support the best performing companies in the future, and so we will reserve money, which is also another important question that startups should be asking in terms of size of fund and where you are in the deployment of that fund, because this will likely not be, especially if you're an early stage company, the last time that you will need to come back. And so you might have financial VCs that have a zero reserve strategy, meaning that they will just make initial investments. Everything after that is up to you. You'll have some like us that will also continue to support as long as, we're hitting the things that we all agreed to that would be hit. And so to answer your question, if we look for 10 to 20% of a company, and that company is a 20, 30, $40 million, pre-money or post-money, it's probably a $1 or $2 billion transaction that would need to be on the other end for us to get excited. I mean, we saw in 2024, we saw a little over 7,000 companies.
7,000 companies.
Into our deal flow. I think we made 5 investments, 5 or 6. And so it's a really, really high bar. Now, we don't get it right? Well, we understand that, the game that we are in is if we do what I said 2 or 3 times, 4 times if we're lucky, we've done our job, because we know things will go to zero. We know things will be singles and doubles, which again could be great outcomes. But we understand that we need to catch some of these really great companies, which, in our space, there's, I wouldn't say limited opportunity, but one of the things that, we probably, of the 55 investments that we've made, maybe 10 or 15%, I would say, are kind of pure auto commerce plays. And so we're happy to understand this industry, but we also want to make sure that our scope is broad, which gets into our limited partner base. So we've got probably 40 corporates or so, maybe a little bit more than 40 that have invested across those 3 funds. We also have a whole host of financial LPs, which we would think of financial LPs, and so institutional investors, high net worth individuals, family offices. And the strategic motivation for investing in a fund like Autotech is very different depending on who you're talking to. And so on the strategic side, I would say that the vast majority of those investments are strategic first. They want what we know. They want the deal flow. They want access to intelligence that we're bringing, right? Because we're not talking to 7,000 companies, but we're meeting with a lot of them, right? And we've got this kind of ground up view of where the world could be headed. None of these companies are going to change the world tomorrow. However, if we've done our job, the next 3 years, 5 years, or even 10 years, these companies could be really big, impactful players in the market in which they're going after. And so that intelligence can also bubble up to some of the largest corporations in the world, which are some of our LPs, thinking about how does that impact my business, right? But then the financial LPs, the ones that only care about how well we are doing financially, keep us really honest on, our deployment pace and, the IRRs and the TVPIs and all of these other, acronyms that we could throw out. And so it's a really interesting space where we play because we have to cater to both.
Cool. Okay, so we only have a few minutes left. I could spend hours up here, literally. This is awesome stuff. But let me ask you this. So think about this. So there's a bunch of entrepreneurs out here listening, and there'll be more listening online. An entrepreneur gets an opportunity to pitch you. What's most frequent to knock them out, i.e. 5 minutes in, you're like, I'm never going to talk to this guy again, or gal. Or conversely, what earns them the right to have the next call with you? What do you typically see and hear that either knocks them out immediately, you're like, no way in hell, or you're like, I got to have another call with this person? Yeah,
so I'm going to give you some background before I answer this. I'm a big believer that if you can't get to the point quickly, you're not going to be able to sell your product later. And so if you're talking to me and you're asking for $5 million, and in the first 45 seconds, I can't quickly understand what you're doing, I literally turn my brain off. And I can't believe I just admitted that, because a lot of people are going to hear that. But I kind of want people to know, get there, sell me, and convince me, hook me, and then I'll listen to you. But if it's a 3-minute, 5-minute preamble to all this other stuff, and then all of a sudden I'm like, I'm zoned out because you can't sell, I have a huge problem with that, right? It's my tick. It's the thing that bothers me.
Cool. Let me just jump on that, just double click through on that. We were just talking about this at dinner the other night. I'm really big. For me, it's like an aha moment where my brain's listening, understanding, and trying to figure. I'm a big product fit guy, maybe because I'm an operator by nature. Like, wait a minute. Don't make me work really hard to get to that aha moment. Get me to that aha moment quick. So what it is, very simply, what is the pain? Is there a pain? Is this a solution looking for a problem, or is there a real problem? So tell me what the pain is, and then tell me why you. At its core, what are you doing? What is the pain out there? Why can you solve this better than anybody else? That's what my brain is thinking. Like, why you? And then I can then go to the next, which is, now we'll talk why you, why is your technology so great? If you leave with all your technology, I'm like, I don't even know what you're doing, and why would I want you? You do that, then we get into all the rest of the diagnostics, but for me, that's it.
That's the deal breaker. Brian, same question, and you can wrap. This is it. Words of wisdom on the way out.
For us, we talk a lot internally about tidal waves. What has happened or what is happening in the industry that's going to dramatically change the way that we're doing business today? And how does that tidal wave help lift this idea that this entrepreneur is talking to us about, right? Because every entrepreneur, every deck, every pitch is, hey, we're unique, we're the first ones to ever come up with this, we're better than, and we're different than everybody else, which are all the important things. If you don't get to that, agreed, that it's hard to get to the next conversation. But it's also the articulation of what is happening in this industry that you are uniquely positioned to take advantage of, because it is really hard. There's a lot of recall and repetition in the work that we're doing, and everybody up here has had years and years of experience in this industry, and so it is likely, it's not always, but it is likely we have seen your idea before. And so not only I agree 100% with what these gentlemen are saying in terms of the uniqueness and getting to the point, but also the articulation of understanding the larger environment and how that's going to change is a really, really important place for us, because we are spending a ton of time ourselves thinking about it to get to an investment thesis before we've even talked to you. So if we've accepted a meeting, that means you have hit a box for us that we've already thought deeply about. And now it's your turn to tell us what we know or what we don't know. And those are usually the most impactful conversations.
Well, guys, thank you very much. Brian Donnelly from Autotech Ventures, Chase Fraser from FM Cap, and Bill Cariss from Holman Growth Ventures. Thank you very much, guys. And we're on the ASOTU CON podcast stage, powered by Space Auto. Thank you.
Thank you, Steve.
Thank you for listening to this ASOTU CON session brought to you by Space Auto. At ASOTU, we're obsessed with uniting people around one big idea, that thriving people are the only path to a thriving and profitable industry. If that resonates with you, head over to morethancars.com to join our email list and explore our full list of podcasts.